Hello, and welcome to another episode of TacoBytes, your Daily Bite of Degen, episode number 495. What are RWAs and why should I care? With us today, we have founder Andy Singleton from Sweeper Finance. Andy, how are you doing today?
I'm doing great, Taco. Thanks for livening up my day.
That's what I try to do, make it a little bit better. And in all fairness, this is long overdue. Being part of the Sweeper team, it's sort of an honor. I get to be, help share the world of RWAs because everyone talks about them, but everyone's like, what is it? So
yeah, and I likewise, working with you, I get exposure to the crypto side, which is sort of not real. So real world assets are traditionally securities. And what makes a security is two things. One, it's fractionalized, so it's fungible tokens, although sometimes they call them non-fungible. And the other is that you've given your money to someone and they're going to pay you back somehow. So it's a liability of a person or a company. There's a person in the loop, but it's sort of a centralized accounting and obligation. And crypto is not real in the sense that they're, with a classic crypto token, Bitcoin is the supreme example. There's no person that gives it value or is ever going to pay you anything back for anything. It's the software and the system. It's a key to getting into the software. It's a key to coordinating the software, but there's no specific person or entity that's responsible for giving you back any value. And so it's a different way of looking at coordination. Instead of having someone who's running the show, it's decentralized. So real world assets has that real world link to a real world person or entity. There's other categories other than securities that are pretty interesting, like commodities. So you can get a token that represents a bar of gold, or a little bars of gold are pretty small.
I have a 1 gram bar of gold.
All right.
Yeah.
And I'm going to tell a story because I'm sort of a dollar maxi. And one time when I was a younger man, I was hiking in the Amazon jungle and I came upon a man who was panning for gold with his little kid. And I chatted with him and I bought a little gold nugget off him and I gave him a $20 bill. And he was so happy. He held it up to his kid and he said, "Ese se recibe por todo el mundo." This they accept the world over. So it sort of gives you a contrast between, it's great to have a piece of gold, but it's also great to have something that's super mobile and accepted the world over on networks. Yeah. Other class of real world assets are things like a lump of something, a house, a watch. There's really not much activity in trading that in tokenized form because you don't really need the token to do that. In fact, you don't need the token to trade or represent any of these assets. And the major question is, well, why token, right?
Yeah. Now, there's a lot of people that might argue that aspect, that it comes to the intrinsic value at times, that at sometimes we may want that $20. Instead, sometimes we may want that chunk of little gold. Other times, neither one of those are value and we'll want that gallon of water. And so, but right now the world is moving to, as you said, code. That's how it has been. So how do we figure out that intrinsic value right now?
Well, it's typically easier to figure out what the intrinsic value in dollars is of a dollar denominated real world asset. So that's kind of the main utility right now of what they call real world assets in crypto, is you can buy $1, which is backed by, you can trade it in for bank money. That's a more of a real world asset than crypto money. Or you can buy from Sweep and other kinds of vendors, essentially a money market coin that eventually you can trade for dollars, but that also is invested to earn you interest. So it's sort of like being part of a real world bank. And it's pretty easy to put a dollar value on those. It's also easier to put a dollar value on a company that has assets and sales and does normal accounting than it is to put a dollar value on a protocol. So that's one of the reasons why regulators, for instance, prefer real world assets. It's very difficult for them to bring themselves to admit that there's a network value in a pure crypto token.
But what we're seeing worldwide, we're seeing acceptance of what might be considered tokenized securities or tokenized real world assets. We're seeing a demand for that, and it is one of the buzzes that is going around right now. How is that being fed, and what are some of the solutions people are coming up with?
Well, I have maybe a different perspective on the vogue for real world assets because I actually participated in the last round in 2018, and that was a complete failure. So people bought ICOs, and some guys like me thought, hey, well, why don't I just clean that up and make like a tokenized security registry, and then you'd get real shares, and that would be better than getting ICO tokens. It turns out that is better. Most of these ICO tokens were pretty bad, but on those two evolutionary paths, improving ICO tokens, which eventually became DeFi and eventually had token economics that were pretty effective and revenue generating and governance that was reliable, that was one track, and that actually worked pretty well. It turns out that nobody bought securities in the tokenized form. So it's been tried over and over again for the last 5 or 6 years. The most common thing that people try is they're venture capitalists and they want money. So they try to sell their LP shares, their limited partnership shares in their fund in a tokenized form, or they're private equity firms. They need even more money than venture capitalists. And they've kept afloat this idea that a platform like Securitize, for example, is going to be relevant. They're going to take these LP shares and they create a channel to a new type of buyer that's crypto native or international, or just doesn't have access to the big chunks of sort of $250,000 or $1 million commitments that private equity firms deal in. So that's been tried many, many times. People don't generally buy those. They also generally don't buy bonds and stocks in tokenized form. And there's reasons for all of those things, but mainly they're not getting anything when they accept delivery of the token. Yeah. They're getting extra custody hassle, but they're not getting any extra functionality. And maybe they were promised liquidity, but liquidity is not just a function of having a token. It's also a function of having buyers and market makers on the other side of that trade. And the traditional stock market and especially bond market system is amazing at providing those things. It's amazing how many bonds you can move through the bank channel if you don't tokenize them. I put up $100 million and it's gone, an hour later. So so there's been a lot of talk about it, but very few buyers for these assets. My theory, so I have a theory.
Okay.
You want to hear my theory?
I do want to hear your theory.
My theory from the beginning was that, well, first of all, I'm gonna give you another obstacle, which is DeFi and crypto is extremely unreliable compared with the existing financial system. So there's, in my estimation, about a 3% loss rate of all assets to hacks, frauds, and mistakes every year. The equivalent number in the traditional financial system is 0.03%. And even
now,
if
is that a reported 0.03%, or is
that's
that
my estimate based on sort of loss and default ratings from guys like S&P and Moody's?
Yeah.
And the reason it's so low is because they can just reverse a transaction. They can just go to their people on the other side of a transaction and say, that was a mistake. Can you give it back? It's very rare for people to argue that point.
Yeah.
And in fact, they put aside collateral so that they can reverse these transactions if they have to. So it fixes a lot of hacks, frauds, mistakes. It's also not anonymous. You can't run off with the money. no matter how much you like, the flight to Rio. So there's that, right? There's this built-in drag, and maybe we'll talk about it later, that makes DeFi not competitive with CeFi.
Yeah.
But there's also this idea that you should get something. Like maybe it's worth 3% to me if I get something. If I get DeFi services, I don't have to go to the bank. I can trade. I can borrow. I can do what they call structuring. I put my assets essentially in a type of loan and create new types of securities and guaranteed collateral obligations and things from that. I can move it around the world. I have a global market. And I have a 24/7 market. I don't have to wait till somebody answers my call for most types of
9:30
service.
to 9:30 to 4:30.
Yeah, exactly.
Yeah.
It used to be like 9 to 3, right? That was the
Yeah.
tradition. So if you really were getting all those services, then you might prefer the tokenized format. And so my theory is those assets are only useful if they're useful in DeFi. Otherwise, why do it? Why take responsibility for crypto custody and this somewhat unreliable system, and regulators hate it. And that actually is proving to be true. So that is a hypothesis I had back in 2018. I got back into DeFi year or two ago and started working on Sweep, which is a DeFi protocol that's designed to consume these tokenized treasuries, these tokenized money market funds. And it turns out they're super useful in DeFi because if you can trade out a zero interest dollar that's sitting in your AMM pool or structuring pool or guaranteeing collateral for, it's guaranteeing delivery and options or perp trade, right? It's just sitting there as collateral. If you can trade that out or sweep it, as we say in the banking business, into an interest-bearing account, then you get back 5%. And that actually is the difference probably between DeFi being not competitive and having shrinking TVL and DeFi being competitive and having growing TVL. So to me, what people are buying right now as RWAs is these tokenized treasuries, these money market funds that yield about 5%. And they're using it in the way that I'm describing. They're taking out the zero interest dollars where you're sort of paying a 5% tax to Circle or Tether. And they're getting that yield back into their protocol, their smart wallet, their collateral pool.
And so those protocols are earning that interest by you just holding your dollars in your non-custodial wallet, and it's not really, your money's not working for you. But you're talking about
the way that it works,
the money to work.
The way that the game works is you buy a dollar from Circle using bank money, and it becomes a USDC. And they take that bank money and they invest it in a money market fund that buys a lot of things like U.S. Treasuries. That's why in this part of the cycle, it's mostly governments or sovereigns, as they call it. So they're holding, and they're making 5% on that, and you're making 0 holding your stable coin. When you trade that in for one of these RWA style yield bearing coins, the first thing that person's going to do is take that USDC, send it back to Circle, get the bank dollars, send it to their brokerage account, and buy the same type of money market instruments that Circle bought.
Yeah.
But now they're passing through the interest to you instead of just holding it for Circle and Coinbase. Now, Circle and Coinbase do that also. So if you take your USDC and deposit at Coinbase, now you get 5.05%. I think they told me the last time I checked. So they're actually really good about passing through the interest through their own channels. And that's one of the big reasons they're having a fight with the SEC, because the SEC is going to say, well, either that's a security and you have to handle it differently through these really old, complicated clearing and settlement rules that they have, that account that Coinbase is paying the 5.05% on, or that's you're a bank because of Reeves, and you have to sign up as a bank, and you're not providing bank style capital and controls and submitting to a lot of pretty annoying things that banks have to do. So So they're doing it too. But when you deposit your USDC with Coinbase, you can't use it in DeFi. It's been
Yeah.
extracted, right? Yeah, you're getting the interest, but the DeFi is all about double dipping. I have
And
my
we see that.
interest-bearing coin that's paying the 5.05%, but it's also collateral, for some other investment that I'm making.
Yeah. And so you brought up double dipping. We see that a lot in DeFi. I go and put, whatever token I may have in a liquidity pool, and I'm earning interest on the trading fees. And then it also might be incentivized. So depending on how degen it is, and how exotic the token is, I could be making some crazy percentage APR, but really I have to worry about impermanent loss. I have to worry about this hyperinflated token that's being distributed to everyone in large quantities. And if it's not auto compounding for me, that I lose value in and of itself. And we sort of get hit with those hidden numbers in a way. I'm earning 500% APR. Yay. All of a sudden, though, I am moved out of my position because, one token trades too far to this one direction, and have impermanent loss. But then at the same time, this token that I thought I was getting that was feeding my APR is now heavily diluted. So what do you think is one of the solutions for that? And what is Sweep doing for that solution?
Well, pick your poison. You get 5% in CeFi with none of those games, and 10% in DeFi with all of those games. And that's actually the reason why we're in the middle of a great rotation. So if you go back and read my blog, you will see that 2 years ago, when everybody was moving into money into DeFi, I said, look, it's really easy to print new dollars like DAIs and stuff in DeFi. This is going to reverse. We're going to be printing dollars in DeFi and investing them in CeFi. In fact, that's exactly the phase we're in now. But when I set up Sweep, I said, look, we should be able to invest in both CeFi instruments and DeFi instruments.
Yeah.
We provide margin loans. So we're not an investor, we're a margin lender. But
Yep.
we should be able to place money into both channels, because the yield is going to shift, the competitive yield is going to shift back and forth. In fact, there's a third category, instead of governments, commercial borrow, which is actually where you want the money market to be. You want most of the money to be going into commercial lending, where people put the money to work and make new vaccines and build new houses and highways and all that sort of stuff. So we're in the middle of a great rotation. People rotated a year ago out of DeFi and into CeFi, right? And now they're rotating back into DeFi. And the reason is because with all those games, there is a difference in yield between DeFi and CeFi, which is the Ponzi token rewards, right? How many token emissions have you minted? And people like those, and they take them, and you have to be careful, but they can have value and they can add extra yield. So that kind of the game we're in right now, as I sit here, is taking dollars, making sure they're swapped into these money markets and getting that underlying 5%, but also getting some of that extra, making sure that's fully collateralized, right? You can't lose that money.
Yeah.
But you're using some of these DeFi promotions, just sort of. When I was a kid, I'm old, right? Banks used to give you a toaster when you opened a bank account.
Yeah.
That's sort of like what these DeFi rewards are, and that's enough to add a couple percent on top of the CeFi yields. So as a result, we're rotating our allocations back into DeFi.
And so you and me, we talk daily, and so some people might get lost in our conversation because we're leaving some of these important things out. You talked about the three different aspects. Commercial loans right now. What were the other two? Can you clarify those for people that are listening in?
Well, I have a mental model of where you would put, if you have $1 and you just want a safe place to put it. There's lots of places to put it, because what you're doing is you're buying essentially the safe tranche of the structured product. Like a bank puts in 10% capital
Yep.
And then you put in 90% deposits. Any losses should go to the bank. They should absorb that in the 10% capital. And you can go to almost any asset class and you can get some safe investment out of it as long as somebody else is putting capital in to
Okay.
absorb losses. Of course, they
And do
also
we
take
see that?
profits, right? They
Do we see
pay you
that for the
5% if they
everyday
make 8%.
person?
Mm-hmm.
Do we see that for the everyday person? You know, or is this where DeFi comes into play, that the everyday man can now participate in these things?
Well, you've always had the opportunity to participate in the safe tranche, right? To go to the bank and hopefully they put in enough capital. With DeFi, you can also participate in the risky tranche. So the people that put in the 10% are going to accept losses, but they're also going to make any gains over the basic savings rate. And that's why they do it. So and you definitely have access to much more of those kinds of positions through DeFi if you want. But I was making the point that lots of different assets can give you essentially a savings account where you're just getting the basic 5 or 6%. That's what we're trying to do with Sweep. And there's a use for that. Most money is not held by people who want to do degening. And actually, I feel the market for just dollars, where people don't want to have to think about it at all, and is much bigger than the people that are moving money around to try to sort of maximize their return. And the biggest market of all, think about my hypothesis, DeFi is the consumer. The biggest market of all is protocols, collateral pools, self-custody wallets with smart sweep features, either apps or neobank apps, or these smart self-custody wallets. So once you embed a savings kind of product into those things, you don't want to have to think about it. It's not really an investment. You're just trying to get competitive, right? A competitive rate, not the maximum rate. So that's a market I think a lot about. But where does that money go is the question we were talking about. Right now, or over the last year, most of it's gone to the government. So the U.S. government said there's too much inflation. We have to take this money back. So we'll pay a high rate of interest on it. They bumped the interest rate up from 1% to 5%. And as a result, about $50 billion per week was flowing out of lower interest bank accounts into money market funds that were buying these treasury securities. They were the highest bidder for all the money in the world. And in stable coins, it was about $500 million a week. So you can think of stablecoin business as being sort of 1% of the banking business.
Yeah.
And that stopped now. That flow has stopped. Eventually, what should happen in a healthy economy is that money will start to go to commercial loans or commercial paper, companies that can put the money to work,
building
and
infrastructure,
actually make money. Build stuff and make a profit on it and give you back real returns that represent growth in the economy.
One thing,
but there's also these DeFi thing. Right now the amount of money in DeFi is so small that it can be sort of absorbed in these reward boosted schemes. So that's the phase we're in now. Is as long as the market caps are growing, there'll be like this specialty market. DeFi is tiny, tiny, tiny. You can only put a few $100 million into DeFi before you just crush the yields, which would be like one button press in the U.S. Treasury market. Yeah, which is three trillions a day in turnover kind of thing. But that's the market we're in right now.
Okay, so there's a couple things there that I want to touch on. One of the things that want to clarify that at least from what I have seen as a everyday user, a lot of the money market accounts that banks have, you have to come in with a minimum dollar amount, usually $5,000, $10,000, $15,000 to be a player, so to speak, and then it's locked up for 12, 18 months, a month, something like that. But Sweep makes it so that anyone can get into it with $1, and they can get in and out, or they can get into some of the other things that are going to be coming out in Sweep as well later on. And we'll talk about those. But do you think that DeFi also allows every person to get into it too?
Yes, I think that is an advantage of DeFi. Banks have a lot of overhead, and they don't offer very good terms because it's expensive to run a bank, and they need decent sized chunks in order to run their labor intensive process. And although DeFi has a high loss rate, has all
Mm-hmm.
these little risks of hacks, mistakes, and fraud. Um, it's very, very efficient. It's very low overhead. It's just software. So sure, you could put $1 in a lot of these L2s. You could put $1 in and do okay. And
Yeah.
and if a properly designed protocol, and I won't say that anybody is properly designed right now, but a properly designed protocol would be able to do what a bank does with a savings account, which is make it a demand deposit. That's the hard thing a bank does, is to say you can come get your money back at any time.
Yeah.
It's hard because they sent the money somewhere else to invest it, and they have to
Yeah.
kind of have a buffer and reel it back. And that's what we spend a lot of time thinking about with Sweep. But of
Now,
course, it's easier if you just say, okay, lock it up for 6 months, which we call staking in DeFi, and a CD, or a bond in the banking business. That makes it a lot easier, and that's where the bigger transactions will go.
one of the things that you had mentioned earlier, that a lot of people in DeFi have learned more about the financial system in the past 2-3 years than most people have in their lifetime. But one of the things you touched on was being being fully collateralized, meaning having 100% of the dollars to back up the token representing each dollar, so to speak. Sweeper is doing that.
Yes, and there's many kinds of real world assets and many kinds of investments, and some of them are volatile and don't have any kind of accounting underpinning. But generally, the sweep style savings accounts and have a capital buffer under them. There's a borrower that's put
Yep.
in margin money. It's the exact same way that DAI is backed. When you create a DAI from some amount of ETH, there's extra ETH there to absorb losses, and that's the way that we approach our savings product. And we think of it more in sort of banking terms. There
Yeah.
needs to be a wholesale borrower that's putting in that bank capital. That's one fragment of the RWA business, but I think it's an important one. It's certainly one that
I remember about a year and a half ago how much DAI was being minted when ETH was $900, and how much ETH MakerDAO got their hands on over a 3-month period where ETH was, from $900 to $1,200. And now we're seeing ETH at 24, 23. MakerDAO still has that. And so does that put them at a competitive edge?
Well, actually, I might have misspoken about the ETH. So
Yep.
what happened with MakerDAO is people had a lot of ETH, and they wanted to leverage the ETH, so they minted DAI. They have $150
Yep.
of ETH. They'd mint $100 worth of DAI, and then they would use that to buy more ETH or something. So they were leveraged long ETH.
Yep.
And then when ETH went way down, they said, screw this. And they bought back all their DAI and they paid back their loans. So they no longer had these big leveraged ETH positions. That created a huge problem for MakerDAO, because the people that were deleveraging and, selling their ETH and buying back their DAI were actually people that wanted to hold DAI. They wanted to hold dollars instead of ETH. So they had a big shortage of DAI. So what they had to do was take USDC. They had to import money from the US Federal Reserve. They had to take USDC and wrap it and say, well, if you put one USDC in, you'll get a DAI back. And that's how we'll provide enough of this DAI, since nobody's making it from ETH anymore. They ended up with over $5 billion worth of USDC. And yes, they still have a lot of that. So the problem with that is when people were borrowing against ETH, they were paying 3% interest.
Yeah.
When they wrap a USDC, because Circle's keeping the interest,
Yeah.
it's 0. 0% interest. So it hit their revenue pretty hard, but worked out great for them because it turns out that over the last year, interest rates on those USDCs went up, those dollars, about 5% over the 3% they were getting for lending against ETH. And so they created this real world asset strategy. And by far the biggest real world asset investor in DeFi is MakerDAO. So they have somewhere in the range of $3 billion of that USDC that they've redeemed out and bought things like money market securities. And in fact, they also have the most popular savings coin, SDAI, or DAI savings rate. And they have about $400 million worth of USDC that they're still keeping. It's just what they call cash drag. They're willing to not make interest on it, which could be used to redeem this SDAI. So actually, in SDAI, it doesn't require any permissioning. It's actually kind of crushed the whole tokenized treasury market because you can get this good deal from MakerDAO because they had all this extra money lying around.
Yeah. Let's roll back for just a second. I want to reset. First off, I want to just thank everyone for joining us from LinkedIn, 0x Degens YouTube, TacoBytes YouTube, Twitch, Twitter, Unlonely, Rumble, Kick, and Telegram, as well as those that are joining us on the Twitter space itself. I'm sitting here today with Andy Singleton. He's in the crowd from Sweeper Finance, who is our co-host today, which is on my other phone. Because I was able to be brought on to be part of this team as we're working on building out partnerships with layer ones and layer twos, as well as other partnerships within the DeFi ecosystem or blockchain ecosystem. But who is Andy? Who are you? And how do you know all this stuff?
I'm a computer programmer from way back. And one of my credentials is that back in the early 90s, there was a vogue for artificial life. It was the last round of AI 25, 30 years ago. I bought a house in New Hampshire and I built racks and I filled it with single board computers so I could run an evolutionary algorithm. That was the kind of inductive AI that we ran in those days. And I got traders to fund me to try to develop trading rules and things like that. So that was the kind of thing I used to do. Have a Harvard math undergrad. When I got out of college, I did something interesting and traumatic, which is I went to work for a guy named Ivan Boesky. And he is the guy that was fictionalized as Gordon Gekko in Wall Street. He was he ran a big hedge fund, but he also did insider trading where he would get news about deals. And eventually they threw him in jail. And the people who worked for him couldn't get jobs. So I went to work for his chief financial officer, who started a company called S&L Securities. And the guy's name was Reed Nagel, a very good entrepreneur. And what he asked me to do was build essentially an automated database system to analyze banks. So in those days, there were thousands of public banks and savings and loans. It was called S&L Securities, savings and loans. And we would analyze their balance sheets in automated and also human ways. We extended that to asset-backed securities. And the reason that that's relevant is because everything we do in DeFi now is the same stuff. It's just represented in a different format, but it's the same kind of banking and asset-backed securities accounting. So I actually learned a lot from that. One of the things I learned is to negotiate more for equity. I didn't get equity in that deal, so I quit, and Reed sold that for $2.1 billion. It's now S&P Global Research. But I founded a succession of companies after that. Creation Mechanics, which was the AI, Power Steering, which is an enterprise software company that I got crammed out of, but it did eventually IPO as Upland. Assembla, which is a workspace for distributed software teams. So 20 years ago, I became interested in how do we manage these inspired by open source teams, and I built a platform for that. 20 years ago, long before it was cool. I sold that to a private equity firm. So,
and you wrote a book 10 years ago too.
I did while I was running Assembla, which is the distributed code and tasks for distributed software teams. I became interested in the question of how do you build software that with a distributed team? Is it different than the way that companies would normally do it? And it turns out it is. With a distributed team, you need this focus point. You need what I would call a daily build. It's now a continuous build where everybody is continuously contributing code to the current version of the system. And that type of continuous delivery was actually a new thing back in those days that was driving a lot of success at places like Amazon and Google. And they had techniques for making it work better, like splitting your software into services, so service-oriented architecture. So I wrote a whole book on how to do a good job with distributed teams, which turns
And
out to be a really useful skill now.
what was your first foray into crypto?
While I was still running Assembla, I got contacted by a guy named Ryan Singer, who you guys may still see around. And he persuaded me to do sort of a halftime gig as the CTO of, he's a big Bitcoin maxi, even was in those days, 2015. He persuaded me to do a halftime gig as the CTO of a company called Blockchain Clearing Corporation. And the idea was that our humble little startup would go to big custodians, right? We figured out sort of how the securities trading system works. And we would give them a blockchain platform to settle trades that spit out of the New York Stock Exchange, these national market system trading systems. And it became really quickly, it became obvious to me that nobody was going to do that with us, and that they were going to do that with DTC, which is a big co-op, a big consortium, actually more, it's sort of like a DAO, right? It's a member-owned co-op of all the people in the securities business that is responsible for that sort of thing. And in fact, though they are developing that system, it's just taking them, I think it's a 15-year timeline. So shows you the difference between, you can't work in that business as a startup. I have like a 1.5 month timeline, right, in my business. And after that, when entrepreneurs started to get in touch with me about ICOs, I actually invested in, as I said, my own platform, Above Board, which was a securities registry, but in blockchain format. I shut that down pretty quickly because I noticed nobody was buying that format. A lot of other companies from that era are still around. And then I spent a couple years not doing crypto. That was crypto winter one. But got interested in it when I saw DeFi, right? And now I'm trying to prove my point that these securities are going to be useful, these real world asset type securities, if we can use them in DeFi. And not just money market funds, the whole range of securities, like the dream of the PE guys, private equity LP shares. Maybe we can do NAV lending and various kinds of structuring if we free them up for use in DeFi. And there's reasons why that isn't happening, largely regulatory, I think. And but there are also markets where you can do it. So if you sort of if you create an interbank market where you screen out all of the US investors, and I can talk about why US rules are so incredibly bad for this market, and all non-professional investors, and you have sort of an interbank market where you have private market exemptions, then you could do a lot, I think, with DeFi plus securities.
And we're starting to see almost worldwide adoption of tokenized securities, or rules and regulations being adopted, countries even making blockchain stables their national currency. We're seeing a lot of movement around the world. Where's one of the hottest places in the world, do you think, where you're seeing some of the coolest innovation coming out of?
Well, I would highlight three locations and plus a booby prize. So when I go to Singapore, I realize that about half of the entrepreneurs that are working in tokenized real world assets, tokenized money markets, that sort of thing, are in Singapore. So a lot of activity there. The regulator there, Monetary Authority of Singapore, says mostly nice things about crypto, but has not been very helpful. Their goal is to sort of suppress the entrepreneurial side of it and use it as a product line for their big banks.
Mm-hmm.
But it's not working because there's so many great entrepreneurs in Singapore. So that's one area. UAE, right? Dubai and Abu Dhabi. So Dubai is where the fun is, and Abu Dhabi is where the money is. And they've created what is actually an amazingly welcoming environment for startups. So they've done a supply side job for startups where they make it easy to get talent and immigration, money, right? They have plenty of money. They have a sort of a
Licenses and
federalized system of licensing where you can go to the licensor that you think is going to pay the most attention to you. Although that can get you into trouble, I learned. But so they've, housing, right? They don't have like very restrictive zoning. They build plenty of housing, water, and other kinds of infrastructure. So they have a very cautious approach to crypto, and which is typical of smaller jurisdictions, and is mostly driven by their need to comply with anti-money laundering rules. Yeah. So crypto has a lot of anonymity. The people that enforce AML rules really don't like that. They're used to being able to go to banks and sort of squeezing whatever information they need. And so these smaller jurisdictions like UAE live in fear that FATF, which is like a committee of guys that set AML standards, is going to get mad at them and put them on some sort of a blacklist that reduces their financial services industry competitiveness.
Yeah. Okay.
And so they're very, very cautious about what they approve, but they're very welcoming to new entrepreneurs as well. The third jurisdiction I would call out is British Virgin Islands. With British Virgin Islands, you can actually create securities with very little muss and fuss, very little, not like these other places where it's a long process with a sandbox and everything else. They'll tell you, look, if you want to get this done, set up with the British Virgin Islands. As long as you're selling your own security, as long as you're not a dealer, you can sell it in tokenized form. And as long as you don't sell it as long as you follow the basic rules for AML, you know who these people are, and stick with professionals so you're not triggering retail consumer protection rules, right? Those are the two big sets of rules that you want to avoid triggering if you're selling securities. Basically BVI is the place for you. They'll support you in straightforward tokenization of these things. The booby prize, I think, goes to the UK. So the government of the UK, the Tories, have said, hey, we want to be, we want to restore the City of London with products like these tokenized money market funds. City of London is the global center of euro dollars. And euro dollars are stable coins, right? It's the same market, just a slightly different format. So in theory, they should be dominating the stablecoin market. But the FCA, the regulator there, doesn't listen to their own government, and they have a strong incentive to just not approve any kind of licensing, and they've made life difficult. It's created this cross current for crypto. They don't want to take any risks with it. So did that give you like a tour of the crypto world? And obviously there's the big picture, which is regulators right now in the US really don't like crypto. They're trying to get rid of it for a variety of reasons, ranging from can't apply the same AML rules, or they don't think they can. So, that's the latest rallying cry: eliminate terrorist financing. Mostly, they have a very effective securities system and a pretty good banking system. Best securities market in the world. So why mess with that, right? We have an incumbent market. Why cause any problems with it by going outside that? So very much against crypto right now, but politics, right? It's still in play, but they are not good faith actors. They really want to eliminate it. It's not that they want to regulate it and make it better and better for the economy. They just want to get rid of it, which is very disappointing. China did try to get rid of it. So, two biggest economies in the world, not happy
We
with
see
crypto. China
China
doesn't like
starting.
crypto for very, very straightforward reason, which is China has sort of proved economists wrong. Economists have always said that you can't control the flow of capital. It's
Yeah.
really expensive to try to prevent people from investing in your country or out of your country, but they actually are good at it, and they're able to sort of retain money in China. And if you can buy a Bitcoin and send it across the border, then that punches a big hole in the capital control. So they don't like it for that reason, and they moderately effective at suppressing it. So those are the big stories.
All right. So, well, you talked on something there that maybe this is a large can of worms and stuff, and we current market in the United States. I agree, almost wants to eliminate crypto because then it would be a can of worms that they wouldn't have control over. But at the same time, we see these large banks and large players not wanting to miss out. And so we have them creating Bitcoin ETFs and ETH ETFs. And so is it really that the US regulators don't have control, or the banks weren't ready for it yet? And they were waiting till that they had enough of a power play to be able to say, all right, now you can do it.
I don't think banks are saying now you can do it. So actual crypto involves self-custody wallets. They really don't like that idea because then you don't have a bank that's properly designed. You have things like Sweep that are open source software.
Yeah.
And
anyone can use it.
Right. So they are trying to get rid of that side of crypto and, probably kill the golden goose, right? They're big companies. The ETH maxis that are selling the ETH ETF, are not nearly as influential as the people that run the core banking business that want to get rid of self-hosted wallets. But it is it's still in play, right? It's a political discussion. Unfortunately, it's not a policy discussion in some cases. It's just an ideological discussion.
And sometimes it's
not a good faith attempt to find the best policy. And that's what we have to get to. And what I think people in crypto are looking for, and most people in banking.
You touched on two things there, and I want to roll back to something else you had said. You said good faith, and then also politics and AML stuff. And so I want to roll those all together real quick. We see people that we would think should be acting in good faith in politics. Instead, I'm just going to call it lying about some of the ways that crypto are being used. But then on-chain analytics are showing that as much money for terrorist funding isn't actually being used for terrorist funding. And these politicians are sort of being put in their place. Does that when that proof of blockchain transactions are being shoved in people's faces, the transparency of it, do you think that helps blockchain's case, or
well, the reason I use the word political is I think people tend toward extreme statements. So the fact is that crypto is used by people you don't like, and in fact it's used by people that aren't supposed to use it that you might like ordinary shopkeepers in Iran that use Tether on Tron, right?
Mm-hmm.
Those are good people. I know a lot of them. And it's also used by people you don't like. Same thing with the banking system. So no AML system is going to be 100% accurate. But people make these very absolutist claims, and rather than trying to figure out, okay, what are our control points? How do we use them effectively and also economically efficiently without just posing crushing costs on the users of these systems? And so it's just avoiding making these claims. Oh, you're lying, and you're all traitors, right? Elizabeth Warren, she sends this nasty letter to everyone working in crypto saying you're traitors. You were in the defense establishment, and now you're traitors because you helped a crypto person. Not helpful. We're trying to find a way that actually produces useful services.
I sort of like to liken it to banking the bankless in a way, especially like you brought up a date seller. People that have a hard time, you know, transitioning money, transacting money, but blockchain makes it a lot easier for that transference of it.
Right. And what's actually happening is the US Treasury is reaching into all of these countries that have shaky banking systems and pulling out the business that they want. So it's unclear why they don't like that process.
Yeah.
When I met a guy in Dubai who was literally running a date shop, and he was from Iran. He was a Persian guy, and his eyes lit up. Oh, you're from America, the superpower. You know,
Yeah.
he was a big dollar supporter. So um, that's another way to look at it. This is globalization, and globalization can work for you. So that's the argument that crypto people are making. Euro dollar guys like me are going to
Yeah.
make, that is that it can work for the US and all the other stakeholders. It's an essential utility.
All right. Um, some of the cool things going on at Sweep Protocol. We're on 5 chains right now. We're on Avalanche, Base, Optimism, ETH. Got to be on ETH, and Arbitrum. But we also partnered with Layer Zero and using Layer Zero's technology to basically go everywhere that Layer Zero is. Now, why is that?
I designed Sweep Protocol not to be launched on a particular chain, and that's a issue because you don't have a natural community. But I feel like we should be delivering our dollars, our interest-bearing dollars, anywhere where there's DeFi. And so we were able to design a system that uses the Layer Zero, what they call omni-chain fungible token. The Sweep
Yep.
deposit token can move around, and we were able to coordinate all these chains in a very simple way, which is we buy and sell the Sweep coin in AMM. That's our main point of sale, and that we actually adopted that idea from Frax,
Automated market maker for the, yeah.
an automated market maker. And if people are saving a lot on one chain, so buying a lot of Sweep, that's how they save, right?
Yeah.
And they're investing a lot on another chain, so they borrow Sweep and sell it. They mint Sweep and sell it to invest it. Then the price is going to be a little bit higher where the savers are buying it, and a little bit lower where the people are investing. And you get a very simple way to move pretty big chunks of money to new blockchains. That's important for our strategy right now because these new blockchains, as we rotate into DeFi strategies, that's the place where there's the hot economies with a lot of rewards and a lot of
Yeah.
yield. So, and it's a way to help us. We can actually bring assets. The amazing L2 funding machine, in an exaggerated way, describe it as. So, hopefully, we can support we're the savings bank for DeFi, right? Support the economy in your local community, which is your local blockchain.
Nice. One of the things that I really like that Layer Zero brings on, as you were talking about the OFC, and I said that wrong. I know I did. But with the omni-chain fungibility, one of the security layers of it, it doesn't stockpile token if you're moving it to another chain. It burns it and then mints it on the new one, so that there's not ever a big stockpile for a vector of attack or anything like that. And so it brings a good layer of security to it.
Yeah,
What do we have?
the bridges that were built more than a year ago are what they call custodial bridges. You put
Yeah.
your coins into a big pot on Ethereum, and then you sort of represent that
Pot somewhere
reserved
else.
coin pot somewhere else, and you can get into really big trouble if people break into the pot. So the new bridges from Axelar, Layer Zero, and Chainlink are mint and burn. So
Yep.
there's never an extra Sweep token. It's always burned when you move it and minted in another place. And there's always going to be problems with bridge security, but that eliminates one of the really big ones.
Yeah. And so 2024 is days away. All right. It feels like 2023 has been a rebalance and, a moment to catch our breath. But everyone's just been building amazing things. What's coming up in 2024 that we can talk about?
Well, the interest rates are probably going to come down, so that it sounds like a small thing, but it actually affects everything in the world, and takes money out of these like savings products and incentivizes people to put them into riskier, more interesting kinds of investments. So that's why everybody's so excited about what's coming up. Um, I feel like sorry. um, I feel like as an economy, though, we've done something really big, right? It's not just 2024. Since about 2020, we've gone from what they called the Great Stagnation, where really progress was only happening in semiconductors between 1970 and 2020. You know,
Yeah.
the 737 Max, you kept hearing a lot of oh, we have the new version of the 737 Max. That 737 was first released in 1967, which goes to
Yeah.
show sort of how little happened, and it feels like aerospace. It seems like a lot is happening, and that's going to create a capital shortage. So we have AI, we have aerospace, we have biotech, the new mRNA vaccines. We have reorganizing the financial system around crypto. So we got a lot of work to do. It's a very exciting time to be alive. AI is probably the big story. For me, I want to try to move as much of our sort of coding and operations into AI to take advantage of what a lot of people, including me, believe is going to be a very rapid improvement curve. So if we can sort of get it to work with current technology, then we can get competitive advantage by riding that curve. And there'll be more about that AI, as an underpinning for things like sweep.
Okay. I guess I had left that as an open-ended statement, and you ended it right. I was wondering, you gave me an economic view of 2024. I was asking what's up and interesting in sweep in 2024, and you ended it with the AI component.
Yeah, well,
Will be
sweep is right now we're not hardly even launched. So
yeah.
we have to think of sort of orders of magnitude. How do we get to the point where we're a systemically important financial institution and people are using our sweep interest-bearing dollars as collateral, in the sort of the $4 trillion worth of collateral that guarantees payments and derivatives in the euro dollar system. Like, oh, that's a big leap from, my little home office. But the first thing that we're going to be doing is we're going to be going and figuring out how to get people 8% and not 5% by taking advantage of these DeFi rewards, by bringing complete RWA economies to new blockchains that are going to be willing to subsidize that on the grounds that 3% on $100 million over 6 months is $1.5 million, which is very small price to pay for creating a whole new system for handling securities.
Yeah.
From there, we'll be looking for things like for margin expansion. So you don't make very much money as a DeFi protocol. It's just some software and anybody can run it. We'll be offering a stable coin called Check. So Sweep is like a savings account. Check is like a checking account. You don't earn interest, but it's highly optimized to connect to the banking system and convert at par. It's optimized for payments, just like a bank checking account would be. And hopefully we'll get good enough at being a bank where we can sort of give your money back, that we'll be able to put the money away for longer, right? And still give you your money back. And we'll be able to go to 30, 60-day duration. That's kind of inside ball in the banking system, but it starts to make the money a lot more useful if you don't have to give it back right away.
Yeah.
And that DeFi giving back, right, becoming an actual financial service with useful money to provide the real economy, that's going to really change the political and economic situation. And another thing that I'm sort of curious about, if you're just wondering, like, what am I working on, is fully identified DeFi. So remember, I complained that, well, there's anonymity in hacks, frauds, mistakes. You can lose 3%. That's a huge amount of money spread out throughout the ecosystem. What if we did have fully identified DeFi? And what if we worked on chains like Kinto, where they know who owns each wallet? It's bad in some ways for access. That's the argument. But you might, if you got back 3%, you would do it. Like, the economic advantages of that might be so big that you would get sucked into that system voluntarily. And so I'm sort of curious about what I'm going to try to launch a version of Sweep where everything it does is in these fully identified systems, and see if there's see what the economic difference is, not the regulatory difference, if there's an economic advantage from that.
Okay, nice. This is going to be an exciting time. It's going to be the year of the dragon. So I think that there's a lot of interesting things are going to happen. Um, I'm excited. And what's really for me, I get to talk. I talk with these blockchains and these layer one BD teams, once a month, every other month, whenever I'm at a conference or at a meetup, or I talk to someone like once or twice a day. But this is one of those things to where for Taco, for me, I get to put on my big boy pants, and I'm talking RWAs instead of the meme coin of the day. And so I think that this market is shifting to people are still having their meme coin fun, but they're also growing up a little bit. And I've seen this across crypto, across blockchain altogether. People are finally starting to understand that everything can be on blockchain because it's just software.
Yeah, I think you're right that what we love about DeFi is it's fun, and I have to be more sensitive to that. We're having some fun now. There can also be mass delusions like Terra, sort of an obvious one.
Yeah.
But actually, if you scratch between that, people are very sophisticated. They've learned a lot. They're building sophisticated software. They built software that held up on 90% asset price declines. No other financial system would be able to survive that. And DeFi came out great, actually, from that. So there's actually a generation of people that have grown up with DeFi that are very sophisticated about this stuff, and they're going to start to bring out services that are useful for everybody.
Okay. We've ran over a little bit. Do we have time if there's anyone that wants to come up and ask any questions, or if they want to put them in the comments, if they have any questions at all, if anyone wants to step up on stage on Twitter, any questions you might want to ask? Now is that chance. Going once, going twice, third time is a charm. I want to thank everyone for joining us today. We've had a bunch of people. Once again, I want to thank everyone across LinkedIn, both YouTube channels, Twitch, Twitter, Unlonely, Kick, Rumble, Telegram, Twitter Space video, and Twitter Space Stage for joining us today. Andy, I think this is the first time you've actually been on TacoBytes, so we end every single episode the same way. Some people think it is the worst way, and I've been doing this for 495 episodes, and I haven't figured out a better way yet, so I'm going to stick with it. But since you're on stage, you get to have final thoughts before you get to hear the words of wisdom that I always have, as well as the same worst knock-knock joke on the face of the planet.
All right, I'm going for the knock-knock joke because I had my say already.
Any final words of wisdom? Last thought?
Don't do knock-knock jokes.
That's the best way we got with it. So, Andy, thank you so much for joining us today. If you're joining us on the Twitter channel, you can join. Please give Andy a follow or give Sweeperfy, our main account, a follow and see what we're building as we are launching out some really cool new announcements with partnerships. And we got something cool rolling out in the next couple of weeks. So be ready for that. I'm excited. I'm happy about this. And my words of wisdom, which I've said now for 495 times, a closed mouth cannot be fed, and you cannot feed a closed mouth, meaning if no one knows you're looking for opportunity can never come a knocking. If opportunity does come knocking and no one answers, it's going to keep on walking. And with that, we get to end with the greatest, worst knock-knock joke on the face of the planet. I have now said it 495 times. And it is said with love. It is said for those that have come before us and those that will be coming after us. For those joining us their first time, thank you for joining us. But Andy, knock, knock.
Who's there?